battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office for the past 42 long years. It has been our mission to deliver both clarity and confidence to help secure your financial future. Well, here we are, episode 132, unbelievable. We are rolling right through 2023. Thank you for joining us. I will say the interviews are back with an entrepreneur this week, Paul Voge, CEO and founder of Aura-Bora. They were featured on season 12 of Shark Tank. Don't miss them. Unbelievable. Sparkling drink maker brand. It's unbelievable. It's a really good interview. And if you are wanting a front row seat to the U.S. economy, don't go away after the monologue. Stick around. Paul Voge, CEO and founder of Aura-Bora, joining us on the second half of today's show. So we're going to jump in and talk a little bit about yields, the Magnificent Seven, about a potential recession and where we're at in the cycle. And then, of course, we'll get into this week's episode. Everyone is bearish. Talk a little bit about that, why we're still bullish. But before we do, I want to remind you, Investor Day 2024, which is actually this year in 2023, is coming up right around the corner, less than a month away, November 14th and 15th. Put it on your calendar, get it on the schedule, downtown Naperville at Hotel Indigo Sullivan Steakhouse. We got a stacked lineup, one of the top asset management companies in our area here, First Trust Portfolios, and then topped off with Strive Asset Management that votes the proxies from a pro-excellence, pro-American agenda, not through a political lens, but rather with a pro-American agenda. Just unbelievable story and company. You cannot miss this event, November 14th and 15th, Investor Day 2024, but it's this November in 2023. All right, let's jump in, talk a little bit about what happened in the markets this week. Market was down about 4.5% or so. Kind of a bloodbath of a week. Why? Because Jerome Powell talked a little bit about interest rates. Every time he talks, the market goes down. I would expect this is another short-term decline, and I am willing to make the prediction that it is a short-term decline and that stocks will go higher over the long run. And I do believe we are going to have a rally, whether it's in this calendar year or early next year. Just stay the course, because I do believe that stocks will go higher from the current S&P 500's level of 4250. So do not panic. Don't get nervous here. Stay on your plan. Don't go anywhere. Stocks, I believe, will go higher over time, and I think sooner than a lot of people realize. But the Fed came out this week. Powell said, given the uncertainties and risk, how far we've come, the committee is proceeding carefully. You'd think that'd be good news. It wasn't. Why? Because he said we may have to keep things higher for longer, which I'm not really sure why investors panicked over this. This isn't anything new. This isn't anything the Fed hasn't told us in the past. Obviously, the Fed wants to signal, one of their tools is to signal that rates will be higher as a mechanism to slow people down, to try and get people nervous. And so far, it really hasn't worked. People are still spending. I was just downtown Chicago with a friend the other week. We're out, it's like Friday, Saturday night. Used to live down there right where we went to dinner. And it was packed. It was more packed than I've ever seen in 4 or 5 years. So the economy's booming. People are out there. Consumers strong. And I think you have to ask the question, why is that such a bad thing? Why is it such a bad thing that people have money, that people are spending, that people are in the economy doing well, they're not losing their jobs? We don't want to root for layoffs. We don't want to root for higher unemployment. And there's a lot of people that are rooting for that because then they think the Fed's going to cut rates. That's not necessarily a positive. What's better, what's a much better scenario is that we avoid recession here. We might have already been in a recession. We'll talk about that in a second. And we keep climbing higher over time. Corporate profits go up. We use automation to bring down labor costs and all the rest of it, and people continue to make more and more money. And then that's what drives stocks higher over time. So I think that's a much better scenario to root for than this doom and gloom scenario that we're going to hit this giant recession. We're going to have this massive problem and the Fed will be forced to cut rates back to zero. In a scenario like that, something really has gone wrong. Now, that's not to say that I don't think the Fed could break something. They definitely are going to break something at some point. And it's not going to be the entire economy. It's really going to be, I believe, small business, which is sad. It's going to be companies that haven't managed well through the past 3 years. They, number one, had the COVID shock. That's not their fault. That was nobody's fault. COVID lockdowns, COVID is a disease, horrible and awful. That wasn't anybody's fault. But let's just say you managed through that. Then you bought into this narrative that COVID lockdowns and social distancing and masks and all that stuff were the new normal. Well, you got the prediction completely wrong. So if you built your business around this idea that we were going to have social distancing and we were going to be online forever and nobody was ever going to go back to a concert or an event or a trip or a cruise, you made some really bad investment decisions. And if you were a business owner, you structured your business improperly for the future. Go back and read our stuff. Read from 2018, 2019, 2020. I was writing back then. I think we started the show in 2020, somewhere in there. But all through that time period, I said, hey, it's really bad right now. COVID's bad. The lockdowns are terrible, but we're going to get out of this and we're going to go back to normal, not a new normal. We're going to go back to normal. Well, that was right. 3 years later, you can see that people are going back to Europe. People are going on cruises. They're going on planes. They're traveling. The TSA checkpoint data is at brand new highs. So you cannot build your company or your investment portfolio around these beliefs and ideas that human nature radically changes. Human nature is the one constant in life. So if you want to invest, if you want to build a business, build it around human nature, because that's the one thing that never, ever, ever, ever changes. What's driving the market? Well, it's the Magnificent Seven stocks. It's the top 7 companies. And I think what you have to realize is the doom and gloomers, the bears, and all the people that thought the market would fall apart in 2023. They said, hey, you saw 2022 is bad. Just wait till 2023. It's going to be even worse. The reason they've been wrong is because large cap companies, that's what the S&P is. It's not every company on earth. It's not mid caps. It's not small caps. It's mostly large blue chip stocks, all based in the US, have not been affected like people thought with interest rates. Now, of course, there's small caps that are struggling. Of course, there's mid caps. They're having trouble. But for the most part, these large cap US multinational corporations are sitting on more cash than they know what to do with. And so, in fact, they're not having a problem of financing their debt. In a lot of cases, they're paying off their debt and they're sitting on mountains of cash. Like Apple, for example, sitting on over $100 billion of cash, risk-free, making 5 to 5.5% in money markets and treasuries. That's a completely different environment than I think what people predicted. And that's why the market's up. If you didn't have the eyes to see that, if you didn't have the eyes to understand, you would have panicked in 2022 and then panicked again in 23 and sat in cash. You would have said to yourself, oh, look at me. I'm a genius. I'm going to get 5.5% risk-free on treasuries. Well, guess what? The S&P is up 12. So for somebody to come out and say, oh, we're talking about risk-adjusted returns, or we're going to be talking about returns that are just based on zero risk. Well, you can't eat risk-adjusted returns for dinner. You can't use your risk-adjusted returns at the grocery store. The world we operate in here in portfolio management is absolute returns. So if you're sitting on 5%, somebody else is sitting on 12, that's a 7% difference. And by the way, we'll get into this in a second, but I will tell you, I believe that if you continue to take that 5, even 6% in interest, you are going to be severely disappointed over the next couple of years as you watch stocks largely driven by the Magnificent Seven produce double-digit returns. And so to be sitting on 5% with your treasuries and miss out on maybe 10 or 12% on equity returns, and by the way, I do think that's highly possible the next couple of years, you are going to underperform your friends and neighbors. Stay in the stock market, stay invested. Now, you have to have something in bonds. If you're retired, if you're a pre-retiree, you have to have a couple years in living expenses tied up in some short-term treasuries. That's what we do, at least. But please, please, please do not, and I've urged caution on this for, 3-4 months now, do not go out and buy long-term bonds. Please. Maybe at some time, at some point here, intermediate term bonds with a 7-year duration would make a little bit of sense. But to go out and buy a 20 or a 30 year right now, I think you'd be crazy. And you think, Nick, nobody's doing that. Who's buying 20 or 30 year bonds? Look at the flows on TLT. That's the iShares a ETF that tracks 20-year bonds. It's having the best year of flows it's ever had, I think. It's like up in the top 3 or 4 years of all time with net new flows. So people are buying 20-year treasuries. They're buying 30, thinking they can't go any lower. And I would argue these are institutional people. These are people like us, advisors, who are going out and putting their clients' hard-earned money into long-term debt. I'm sitting there, this is crazy. So please, if you catch the passion in my voice here, stay away from the long-term bonds. Now is not the time. Maybe at some point you could add a little bit, but that's not the point of the portfolio when you talk about risk management. If you want to manage risk properly in your portfolio, don't do it with long-term bonds that are risky, that are sometimes more volatile than actual stocks. Go out and buy short-term money market, buy treasuries. That's what we do. Keep the risk management part of the portfolio, your principal protection part, conservative. If you want to earn alpha, if you want to perform and grow the portfolio to beat inflation for the long run, use stocks to do that. Don't get those two things backwards. Now, there is a group of people out there that are saying that it's just so bad that the Magnificent Seven are the only thing driving stock market performance. And this is absolutely true. If you look at the market cap weighted version of the S&P, just plain vanilla market cap weighted, that means the biggest companies are at the top, the smallest companies are at the bottom. The market cap weighted version of the S&P is up about 12 to 14% for the year. Now, if you strip out the top and you equal weight everything, so Apple, Microsoft, everything's equal weighted with the bottom stocks, that's called equal weight S&P, that's actually down about 3% for 2023. So a lot of people are pointing this and they're saying, oh, the only thing driving the market, the only thing keeping the market up are the best companies. Well, I ask the question, why is that such a bad thing? And isn't that what I've told you to expect, is the big will get bigger? That's the Matthew principle. It's just a phenomenon in life that if you have success and you do well and you manage properly and you don't take on too much risk and you earn returns, that you will continue to do that over time. And the people that don't do that will continue to lose over time. It's not rocket science. It's just part of life. The Magnificent Seven stocks are reporting earnings very, very soon. Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta. These are companies that in a way are even further than being called big tech. I actually think a number of these Magnificent Seven companies, the reason they're so successful and so big is because they're basically utilities. Imagine if you're not on an Apple iPhone or you're not on a Google Android powered phone, you're at a structural disadvantage in the 2023 economy. And if you don't have access to the internet, by the way, 85% of internet traffic is Google. If you don't have access to Google and the internet, you're at a structural disadvantage. So the reality here is, and my point is that you could continue to see these Magnificent Seven get bigger and bigger and bigger over time. You don't want to overdo it. You still want to manage risk. We've still capped exposure at about 6, 7, 8% per name. But we cannot ignore the fact that these companies are the biggest and the best for a reason, and I think will continue to remain at that level. Now, the one thing that I do understand, a lot of people are talking about, Nick, what could take the Magnificent Seven out is a bunch of antitrust regulation, breakups, all the rest of it, spinoffs. Remember, anytime that's happened in history, some of the spinoffs actually unlock and unleash more equity value for investors than the company was worth before. And so if Google, for example, was forced to spin off Waymo, which is their driverless car division, or YouTube, the videos, all the rest of it, those pieces could actually be worth more on their own than they are now under the corporate umbrella. So I wouldn't just immediately assume that because the top 7 companies are driving the market, that that's such a bad thing. That's just part of being a cap-weighted investor. So anyways, that's enough on that. Let's talk a little bit about the cycle that we're in the economy and part of the market. Remember, the economy moves in these cycles from growth back down to contractions. And then if a contraction lasts for 2 quarters with unemployment, rising unemployment at least, then what you have is a recession. So textbook recession is basically 2 consecutive quarters of declining GDP plus rising unemployment. Okay. Last year in 2022, we technically did not have a recession because we avoided having rising unemployment. We had 2 quarters of declining GDP consecutive, but we did not see unemployment tick up. So I think a lot of people said, hey, we still haven't had recession. The recession's still out there. We got to brace ourselves for this looming crisis that's coming in the economy. I think that's completely wrong. And in fact, I don't completely agree that we had a recession last year. I will say it had elements of a recession. There were parts and pieces that looked like a recession last year, but that may be all we're going to have for a while. We may not, and I could be maybe a little wrong on the timing here, but we may not have a true economic massive issue on a wide scale because of the Magnificent Seven, because of the way the economy is set up for maybe another 4 or 5 years. And that would be part of a normal market cycle. These cycles last about 7 to 10 years. And so just because we maybe technically avoided a recession last year in 2022 does not mean that we have to have this big all-out crisis next year or in 2025. In fact, CEOs, management teams, and companies have been bracing themselves. They've been preparing for this recession, this doomsday collapse that just hasn't happened. And I would argue that's actually a positive. That's a good thing. That means they manage conservatively. They haven't exposed themselves to undue risk like we had in 2008 and 2009. And instead, we've had earnings growth for 2023. We're looking at Q3 earnings here. The earnings decline for the S&P was only negative 4.4%. I believe that's going to revise upward and it's going to look a little bit better. I think we're actually going to see earnings growth in Q4 this year. And so that is not indicative of a recession. When you have earnings growth, where you have GDP growth, even if it's only 1.5 or 2%, like the Fed wants it to be, that's not a bad thing. That's not a negative. That means companies are overly bearish and eventually they're going to be forced and have to pivot and buy more inventories and expand and sign office leases and grow their companies again. They're going to have to do all the opposite of basically what they've been prepping for this year in 2023, which should hit in 2024. The S&P 500 is not radically overvalued. In my opinion, the forward 12-month price earnings ratio on the S&P 500 is 17.7. That's below the 5-year average of 18.7 and just slightly above the 10-year average of 17.5. All of this to say that stocks are only about 1% more expensive than they were 10 years ago, and earnings are up double over the past 10 years. Here's my point with all this math, data analysis, statistics, is just to say, when you look at the math, when you get past the narrative and you look at what's really going on in the economy, remember, who are you going to believe? Okay, the media or your lying eyes? Well, if you get outside and you go into the economy for a little bit and you go downtown Chicago or New York or like I was just in Houston, you go out to dinner and you look around, the economy is still booming. That's not a bad thing for stocks. So I think actually investors are way more bearish than they should be. I think pension funds, I think family offices, I think endowments, foundations, I think retail investors are way more bearish than they really should be. And I think when everybody's bearish, I would like to remain bullish. That's the Warren Buffett famous quote, right? When everybody's nervous and bearish and worried, that's the time to be greedy and bullish. When everybody's greedy and bullish, that's the time to be bearish. That's kind of what we did in 2021 when the tech stocks were going through the roof, when Cathie Wood's ARK fund was going through the roof and trading at ridiculous multiples, and tech companies were trading for 10 or 15 or 20 times sales, not even earnings, sales. So if you did $1 million in revenue, you were valued at $10 million, which is just ridiculous. That's crazy, quite frankly. That was the time to be bearish, not to be jumping in on the tech trade. But now you just got to know where you're at in the cycle. People are some of the most bearish they've ever been. So that is the time to be bullish. Piper Sandler just came out and agreed with us that because everybody is so bearish, because stocks are so oversold, people have traded away from equities so much that stocks could be set for a 14 to 16% rally, not in 2024, but this year in 2023. Now, I don't know exactly if they're correct on that timing, but I do agree with their math that stocks are about 14 to 16% undervalued from where they are today. So depending on how old you are, if you're even 70 or 80, I would be buying equities with the anticipation that things will be better in the future. Remember, the market goes down in anticipation of bad things to come. And so there's a high likelihood, and this gets into this week's article, Everyone is Bearish, that because everybody on Wall Street is bearish when asked, and because everybody knows the risk, because the risk is priced in almost instantaneously overnight, because we live in this information economy, that if there's even a slight surprise to the upside, if there's even a better read with inflation numbers, which I think is coming, if there's even slightly one or two tiny glimmers of hope, that this market could take right back off. This is not blind optimism. This is not just wishful thinking. This is based in the data. Earnings are strong, companies are doing good, and I believe they will continue to be just fine. So let's assume we had a recession last year, which I don't necessarily 100% agree with, although it had elements of a recession. Stocks traded off 20%. So you go, hey, that's a big correction. Stocks should have traded off 20% if we did hit a recession. But now let's say earnings are going to be up. Let's say earnings are up 10, 15%. Well, basic math would tell you that earnings will track price. Sometimes the earnings go up faster than price. Sometimes the price goes up faster than earnings. If price goes up faster than earnings, then stocks go into a correction. If earnings go up faster than price, then sometimes stocks are oversold. And again, that's where I think we are in the cycle. So here's my advice, and we'll kind of wrap up on next steps. What do you do with all this information? Number one, I would say buy quality. So not every company is cheap. Don't hear me wrong. I'm not saying every stock is a buy. In a lot of ways, value stocks, whatever you want to call that, can't actually be properly defined. A lot of people, you get asked 10 different people on Wall Street what a value stock is, you get 10 different answers. Instead, what we want to do is look at quality. And so here's how I would define quality, which is much less subjective than value. Quality is defined as a resilient business model, conservative management team, strong balance sheet, and a significant degree of something called operating leverage. So how much can a company raise their prices? How much are their fixed expenses in relation to their revenues? What are their regulatory risks? What kind of industry are they doing business in? Is it highly regulated? And what we also want to do is just say, okay, what is the ROE, return on equity? What's the return on assets? Are they able to generate a lot of positive free cash flow? That's the definition of quality. And so the definition of quality will steer you towards large cap US companies that don't face the problems that Chinese stocks have, that don't face the population and demographic statistics that Japanese stocks face, and don't face a lot of the problems that European companies will face, especially on the regulatory side. What you end up with is the Magnificent Seven. And it's not the only thing you should own. You should own, we've got anywhere from 50, 75 stocks floating around, depending on what portfolio in. If you're a little bit more conservative with our firm, we're maybe a little closer to the 100 stock range. If you're lower and more aggressive or concentrated, we could even do 50 stocks. But the point is that over time, the best companies will continue to get better. I think there's also an important definition of quality, which is not every company is created equally. Just because two companies or three or four or five companies in the same sector or industry or in the same ETF or index or mutual fund doesn't mean that those companies are all worth owning. For example, there's a massive difference between ExxonMobil and British Petroleum. There's a massive difference between JP Morgan and Wells Fargo, a massive difference between Lockheed Martin and Boeing. Not every company is worth owning. And if you have a company that burns a ton of cash and can't even produce returns on that cash or investment that exceeds the cost of capital, that exceeds the 5.5% risk-free treasury rate, then you probably shouldn't own that stock. So I really believe if you buy the biggest and best companies, if you continue to own high quality, people are overly bearish on the economy. They're overly bearish on stocks. They're getting too nervous for no reason. and they are going to miss out on a rally. So at some point we will have a recession. Now, I tend to believe it's not going to be 2024. I tend to believe it might not even be 2025, could be even longer than that before we have a true recession, a textbook version of a recession. But we are in a pullback right now. We could continue to see more of a pullback. Don't let that spook you. And so what I'm doing in my personal portfolio is I put some money in last week when the market was about 4,300 points. I'm down a little bit on that. I'm going to put more in if the market goes down even lower. And maybe I catch the bottom, maybe I don't. But over time, we know that stocks go up with earnings. Earnings are projected to be in 2025, $277 on the S&P 500. If you use historical price to earnings ratios of 18 times earnings, and for the biggest and best companies, it should be a little bit higher, closer to 20, you could easily trade the S&P at 5,000 points the next 12 months, placing your upside potential at 17 to 18%. I'm not saying that this is guaranteed. None of this show is investment advice or specific investment recommendations, but I'm trying to give you an inside scoop, front row seat to how we manage portfolios. And so you go, Nick, I can get 5.5% risk-free in a treasury. And I'll come back at you with, yes, that's true. For a portion of your portfolio, that's absolutely true. But with the other part, where we have to grow and beat inflation over time, we are sitting at one of the best buying opportunities on record that would potentially put stocks 17% higher in the next 12 to 18 months, which far beats even by a long shot, 5.5 or 6% treasuries. If we're wrong and it takes 2 years, we're looking at stocks producing nominal returns of 9% per year. That's still better than bonds that are projected to do 5 to 6%. And I would continue to tell you that I think if you stay invested, if you stay on your plan, you will be rewarded. You will be pleasantly surprised that stocks do a lot better than you think. So stay invested, stay on your plan. Don't get too nervous here. If you got some cash, you got treasury sitting there, and you got a little wiggle room in your financial plan, get invested, get money to work. It's not without any downside risk. Of course, there's always risk in investing. There's always downside. So I've urged you in your financial plan, make sure you're paying off debt. You're not absorbing credit card debt. You're not having cars on finance. You never want to finance a depreciating asset if you don't have to. You pay off your mortgage by the time you retire. Stay out of debt. Be conservative on your expenses. Build up a rainy day fund. Do all of that stuff. And then when you're done with all that, buy stocks while they're cheap. All right, don't go away. We are going to bring on Paul Voge, CEO and founder of Aura-Bora, Shark Tank Season 12. Don't miss him. He'll be right back after this short break. Don't go away. Welcome, Paul, to the show. Thanks so much for being with us.
Thanks for having me.
So for those of you who don't know who Paul Voge is, he is the CEO, one of the founders of Aura-Bora, which is a sparkling drink maker. I'm sure you can say it a lot better than I can, but sparkling water. I would imagine this would compete with LaCroix and Spindrift and some of the other the big names out there.
Yeah, thank you. Yeah, we compete in the flavored sparkling water category. That's what it looks like if you're looking to buy syndicated data. But Spindrift is a great example of another premium flavored sparkling water. The category leader in the world is San Pellegrino, in our country, LaCroix, and lots of big companies, and then a couple of small ones like us.
Nice. So San Pellegrino really is the top one still?
San Pellegrino sells more sparkling water than anyone on earth. Yes.
Wow.
Yeah.
So how far away is LaCroix from that? Is LaCroix still is it still up there, or is Spindrift kind of taking its spot?
No, not at all. No, so Spindrift will do like $200 million ish in sales this year. That's just based on an estimate in syndicated data. LaCroix, $1 billion plus. So very, very far gap. I'd say plenty of companies are trying to take LaCroix's lunch money. Waterloo is probably the most direct example of a very, very similar product. And yeah, a lot of them have gotten to tens or hundreds of millions of dollars of sales, but LaCroix still has quite the head start.
Yeah. So And for people that don't realize how hard it is to do what you guys have done at Aura-Bora, which is get into Whole Foods, Thrive, Sprouts, Wegmans, Publix, and I think you said 7,000 other real retailers. People that don't realize how hard that is, we are pitched as a family office. We are pitched a beverage investment at least twice a week, maybe more. And most of them go to zero. So you guys have already done such a phenomenal job. How do you do that? Like give us kind of the background of your story. And Aura-Bora was started in 2019, so not that long ago.
Sure. Yeah. The background was I drank a lot of sparkling water, a lot of the brands we just referenced. It's a very promiscuous category. So I'd say, and I use that phrase to mean people go on dates with a lot of sparkling water drinks. It's not super loyal as a lot of other grocery categories tend to be. And myself and my four older siblings, we grew up in a home with I'd say, very health conscious Whole Foods mom of sorts. So we were always drinking sparkling water. I never drank soda. And at my previous job, I worked at a small investment firm that had a fully stocked pantry area. And I was drinking 10, 11, 12 cans of LaCroix a day. And then I'd go home and make sparkling water in my soda stream. So it felt like, man, I'm drinking a gallon of this and I don't even like it. And then the soda stream sparkling water I make in the evening, I like way more. Why is that? And it felt odd to me that in our office, LaCroix was by far the most popular item in terms of units consumed, but by far the least popular item in terms of quality. So that was the idea. Why don't you do a craft version of this? What Sam Adams did to beer, or Justin's did to peanut butter, or Van Leeuwen's did to ice cream, we'd love to do to sparkling water. So that was the initial eureka moment. And then we were kind of off to the races. So to answer your question of how we've done it, I think just kind of one store at a time, and yeah, 1 week of sales at a time, and 4 years have passed.
Wow. So how much in sales now?
We have done cumulatively since the start of the business about $20 million of sales in the last 4 years.
Wow.
And we hope to match that very quickly here next year. We'll see.
Oh, wow. That's awesome. And what are the, I think this is kind of interesting for people because there is this, during the pandemic, it was the opposite. It was that everybody was drinking more. And I had clients joking that they took their bill they used to spend on the Metro every month, and it was now going to Benny's, which is the liquor store near us. So that's kind of reversed. People are saying, I drink too much. I now weigh 30 pounds heavier than I should be. You guys are in this space that I think is capitalizing on a lot of people realizing they need to cut back on alcohol. Is that correct?
For sure. Yeah, I'd say we find sparkling water, or in particular ours, that have just slightly more, more unique flavor profiles, a lack of citric acid. We use herbs, extracts, and flowers. So it seems it both is more craft and to the consumer seems more unique. We find we have consumers switching, yes, from alcohol to Aura-Bora, but in addition, also from diet soda to Aura-Bora. I think kind of before this non-alc movement started, it feels like the lack of sugar movement started in a great way. So if you're looking to cut out sugar or alcohol, I think sparkling water is often where you end up.
Yeah, diet soda is just, I know people know this and it's so obvious to say, but it's just so bad for you. It's horrible.
Totally. Yeah. And I got to say, I have many friends who are addicts in programs and in rehab, et cetera. And this sounds like a really aggressive thing to say, but diet soda feels pretty similar to me. Like people I know that are habitual diet soda drinkers, they are seeking it out in places. They don't want to be away from their diet soda for more than X number of minutes. I can think of road trips with friends where we're making stops more frequently for diet soda than we are for gas. So if that's you, I think you might have a problem.
Yeah, that's brutal. No, my wife and I, we're kind of in the camp where we don't drink a whole lot of soda, maybe for a pizza night here or there, we're,
Sure.
little bubbliness without,
Yeah.
being on the, but we drink a lot of Spindrift. We have bought a couple cases here and there of Aura-Bora. So it's good stuff. I think everybody should go check it out. So it's, Whole Foods, right? Thrive.
We are visible,
Sprouts.
yeah, depending where you live. So we're not in Whole Foods everywhere. We're in a couple of regions of Whole Foods. We're in Sprouts everywhere. In Chicagoland, we are in Jewel Osco. I tried to say both of those things right because I'm not super familiar with Chicago. So saying both Chicagoland was a big leap of faith, as was Jewel Osco. Wegmans in the Northeast, Publix in the Southeast, and a whole bunch of independent stores everywhere. So if you have an independent natural market that sells oats in a barrel, they probably also sell Aura-Bora.
So Paul, everybody watches Shark Tank and they see these guys get on there, and then one of the sharks will say something to the effect of, it's going to be impossible to get this on shelves, right? Or get good shelf space. How did you guys do it? That's unbelievable.
Um, yeah. How did we get shelf space? So at the beginning, it was just me in a Subaru. So I was just going around to stores asking if we could sell them more items, doing samples, doing demos for their customers, etc. I'd say Whole Foods was kind of the first major chain to drop. That was a small trade show in Boulder, Colorado. It's the very first day that I had any product. I'd done the first run that morning. This is in October of 2019. And thankfully for me, there was a woman there that was a forager for Whole Foods that tried the product and liked the product. And next thing you know, we were in Whole Foods in the Rockies, in Colorado, Utah, and New Mexico. And then eventually we got the attention of a buyer from Thrive Market and then Sprouts. And it's kind of just one at a time. But I'd say there's no secret sauce to it. It's a lot of, for every 9 no's, we got 1 yes. So we're in 7,500 stores, but I bet there's 20,000 that have seen the product and said no. And eventually we'll get them to say yes, but there's so many reasons to say no of anything. So I try not to take it personally. So persistence, I guess, is the answer.
What are you seeing, Paul? And this is kind of what I alluded to at the beginning of our show, that we try to figure out what's going on in the front lines of the economy. As the CEO of Aura-Bora, are you seeing is there anything out there that really concerns you? Is there anything that's really troubling? I'm sure you have your worries, but what are you seeing as CEO?
What's funny is I could have never, I totally underestimated how running this business would connect me to the broader economy, both in the US and in the world, which is kind of an absurd thing to say. I'll say in the past, there was a huge can shortage. You just named it with the joke about the liquor store of people were buying a lot more cans and buying a lot less drafts. So all of a sudden can prices shot up. That was something I saw a few months before. And then all of a sudden, MSNBC and Bloomberg are talking about how we have this huge freight problem. But if you asked a small business owner that was regularly buying one particular commoditized substance, whether it's a can or a bottle, they would have seen it a few months in advance. I'd say freight in the United States, similarly, I felt maybe 2 or 3 months before I started seeing a broader kind of rippling effect. Today, I'd say this is like knock on wood. I'll start bad news and good news. Bad news for CPG in particular is so many of the publicly traded CPG businesses are dividend stocks. So, Warren Buffett famously, likes to drink Coke while during doing interviews and on air. And he likes to mention how, he gets X tens of millions of dollars a quarter from Coke dividends. Well, the truth is that Coke dividend is pretty steady. But it's now less than the 5-ish% Warren gets from his, money sitting in his money market account. So all of a sudden, CPG stocks have looked a lot less interesting, particularly those beverage ones like Pepsi and Coke. And as a result, we've seen some valuations tumble a little bit. I think that has far more to do with dividends and far less to do with the actual inherent value of that company. The good news from us is I'd say the private, in our case, not profitable food and beverage businesses kind of from 2022 first quarter to now, funding has been extremely, extremely hard to get a hold of. And for a lot of good reasons. I'm sure you're seeing this in your family office. You made the joke about beverage investments. Yeah, these are really, really capital intensive businesses for a long, long time. Even Coke, you could actually, I'll go one level above to the retailers. Albertsons, Safeway, and Kroger are the 2 largest non-Walmart grocery stores in the country. And a well-run Albertsons or a well-run Kroger store can do like 1.5%, 2.5% net profit at the end of the year. That's like not a cash cow business. These are really hard businesses to run. So it makes sense that the brands, if we go all the way down to what's on the shelf, yeah, it's very, very hard to get funding when you're not profitable. It's very hard to get profitable because of the huge barrier. You're not doing the distribution and you're not doing the retailing. The good news is I'm feeling some rumblings that 2024 will be a far more open year in the private markets. That's a sense I get. Maybe you'll disagree with that from both family offices and venture capital firms. And yeah, we're excited and hopefully we can take advantage of that.
No, I think you're right. I could see that too. And we tend to be bullish and optimists long term because that's the only thing that works, And I think as an entrepreneur, you'd agree that if you're going to be bearish all the time, you shouldn't be an entrepreneur,
Yeah, that's right. You'll find it's a very hard job. Yeah.
Yeah, yeah. I think that's the reality. All these market pundits get out there, and if you watch CNBC all day, you'll be good and scared within 30 minutes, thinking the world is coming to an end. And in
Totally.
reality, I talk to people like you, and yeah, there's risk. You have to manage risk as a business owner. That's just part of life. But it's not like you can live your life in constant fear, because otherwise you never do anything.
Totally. Yes. Yes. There's a lot of risk to this, but there's a lot of risk to most things. So I try not to think about that as often as I used to.
Yeah. So how do you think about, kind of long term where Aura-Bora is going? Is it something that you guys are looking to exit on eventually? Is it something that, you build a more substantial business like a Spindrift, or what's kind of the long term?
Yeah, Spindrift is a great example. I'd say Bill Krillman, the founder and CEO of Spindrift, has built an amazing premium beverage business. And I use premium because I think it's impressive that they have managed to stay premium for so long. I think there's kind of a trend in a lot of consumer businesses where you start really premium and then the quality drops as the audience grows right around an exit time. And although Spindrift has not exited, it's been more than a decade now. They continually get into new retailers, continually come out with new flavors. So it's hard to play this game for as long as he has done it. He's done an amazing job. I'd say if we could build even half as successful business as Spindrift is, I'd be really, really happy with that. To your question about exit, we've raised just over $20 million since we started this business in 2019. So yes, we have to exit the business for 100 investors' reasons. I'd say in food and beverage, it seems like the field goalposts keep moving back. Most food and beverage entrepreneurs, if they're beverage, they talk about selling to Coke, Pepsi, Nestle, Dr. Pepper, Keurig. If they're a food company, they probably talk about selling to Smuckers, General Mills, Kraft Heinz, et cetera. It feels like in both instances, there were some acquisitions, particularly in the early 2000 to 2010, where it was organic was new and plant-based was new and higher protein, lower carbs, lower sugar, higher fat was a new idea. And there were a lot of acquisitions that were frankly too expensive, that should not have happened. And it feels like all of the conglomerates, all the strategics have learned from that. So in order to exit this business, we'll probably have to get to $50 million of net sales profitably, above 40% margin, et cetera, et cetera, et cetera.
Yeah, yeah, I think you're right. I see, like, I think one of the big ones here was RX Bar. I'm sure you saw that one. Just an
Sure.
insane exit.
That's a good local story. Yeah.
Yeah, yeah, just a couple of guys from Glen Ellen down the road from us here. So, yeah, I think it proves that wherever you're from, if you got the, I think, motivation, if you've got a good business plan, if you can get some funding, if you work it, obviously it's a ton of hard work, and I don't think people realize how much work it is being CEO of a company. Maybe you can talk about that, but I think it goes to a broader point that the American dream is still alive and well. I think it's unbelievable when you have the right factors going on, and you have I think when look, there's ideas that are not great ideas to get funded even.
For
And
sure.
so it's like if you have a good idea like you guys had, and you work it, there's definitely a reward at the end of the day.
Yeah, I'd say I know, to your point about the American dream, I know several CPG. This is a unique thing, I'll say. Like people use that phrase. Politicians love that phrase, of course. And there's some truth to it of why building a business or building a future for your family, whether it's a business or not, is so great in the United States. I think one that I didn't think about until we started Aura-Bora was in Europe. If you want to build a big CPG business, 10 million is kind of the cap, i.e., 10 million is what you can sell if you're in the UK or in France or in Germany, et cetera, without dealing with cross-country selling across borders, translation of packaging. There are so many barriers to entry that make it very, very hard. Having 300 million Americans that are frankly some of the wealthiest humans who have ever lived, living in one landmass connected by highways for 48 of those 50 states is pretty insane. I know several CPG entrepreneurs that started their business in Asia or in South America or in Europe or in Australia that are now here in the United States, knowing that, hey, this needs to become the biggest part of my business because this is the quickest way to scale. So that is the good news is, hey, if you're starting a CPG business, it's going to be really, really challenging, but it should be slightly easier in the US.
Why is it that And we talk about this all the time, but what's your opinion on, I think you're in California, right? Is where you
Correct.
live?
Yep.
Okay. And California obviously is innovation central, right? But why is it that so much innovation and entrepreneurship and especially in the tech sector happens in the United States? You just don't see that level of innovation in Europe. You obviously don't see it in China or Japan. Why is it happening in the US in your opinion?
I'll stick with my answer on CPG. I'd say a few reasons. One, we certainly have. Actually, I was just talking to I'd say he's probably one of the most well-known venture capitalists for consumer businesses in India. He was just in town at an event a few weeks ago, and his commentary was how jealous he was of the US for having we have two big mass retailers in Target and in Walmart. And we have two big conventional retailers in Kroger and in Albertsons. And we have two big natural retailers in Whole Foods and in Sprouts. And then we have this huge collection of regional retailers in Publix and HEB and Wegmans, in the Fresh Market or Fresh Time in the Midwest. And then throw in, we have this huge club segment in Sam's Club and Costco. And if you're an entrepreneur, like I'll say, those are all on a bulletin board right here to the left of my camera of like, we need to get here and then here and then here. And it's almost like having a friend that wants to be a neurosurgeon. They have to go to a great college, do well in the MCAT, go to med school, get a great residency. And although it is a very difficult thing to do, and then actually getting good at it is an almost impossible feat to do, there is a Candyland map to do it. There's a way to do, there's a clear path. And I think what the US has going for it is probably by nature of our unique land, our unique people group, the wealth that we've built over the course of the last century, there is just clearly a path. I'll say RX Bar, the same thing I just said, they started in Whole Foods, they added Sprouts, they jumped to conventional. They had to have some significant D2C presence at the beginning of Facebook ads, which really helped as well. And it was when they were selling really well at Costco and Albertsons and Kroger that they got acquired. Name any other big CPG acquisition story, I could pass you through the 10 retailers I just named. Other continents don't have that same thing going for them, let alone countries. So that is a huge advantage the US has. I'd say our banks are willing to lend on things that a lot of other countries' banks would never lend on. We have a really robust group of both family offices and venture capital firms that will take big risks. And frankly, to your point about the tech sector, like, yeah, I'm grateful to tech. They have allowed a lot of venture capitalists to hedge their bets in other categories, i.e., without the success of a lot of companies in the city I'm sitting in, there's no way we would have gotten checks. It's people giving checks that were dividends they received from, or returns they received from massive software bets. So I'd say all of it is kind of interconnected, but a big piece of it feels like we just have a robust infrastructure for growing a consumer business that is faster and more tried and true than a lot of other countries.
What's that first capital raise look like? Is it kind of like friends and family on the first round? When did you introduce, was it venture?
Yeah.
Was it private money, like family office money, or how did that work?
For us, it was family and friends. So I am the youngest of 12 Greek cousins, 9 of whom invested in this business, some of which are my siblings in that group of cousins.
With a very short last name, if you're Greek, by the way.
My wife's, sorry, my mom's maiden name is Shangaris. But yes, you're right.
There you go.
That was the first thing. So we raised $500,000. We raised $200,000 from family and friends. The next year, I raised $500,000 from more so angels. There were a couple of small seed funds that threw in 100. That was 2020. 2021, we did a $2.3 million seed round. So cumulative funding was now $3 million. And through all these, I was the only employee, or actually no employees technically until the third one. I'd say that $2.3 million round with a couple of VCs was only possible because of the angels in the previous round, which was only possible because of the family and friends. So similar to kind of the Candyland map with the retailers, I feel like raising money for a not profitable consumer business, you often start with family and friends. Hopefully you find some angels. And if you're lucky, you'll find a excited family office or venture capital firm.
How do you find those venture funds or family offices? Is it just networking? Is it referrals? Is it you have friends that have done it before, so you know the right people to talk to, or do you approach them? Do they approach you? How does that all work?
This feels like it was a big cataclysmic shift in 2022. So I know I'm kind of talking about even though it's only a few years ago, this feels like an entire lifetime ago when the market was just far frothier than it is now. And I'm sure your inbox was far more full than it is now. I felt like it was a lot of networking. And yes, when I got a no from someone, I would ask them, hey, are there 3 folks that you think I should meet? And there's a great tried and true phrase that I think is so accurate, where people say, if you're looking for money, ask for advice. If you're looking for advice, ask for money. So it's often conversations with folks that I truly was looking for advice and they wanted to invest, or vice versa. I was looking to have folks invest and they didn't want to invest, but they had a lot of really helpful feedback. What I think has really changed, and the shift I referenced was, I can think of one investor that invested in our seed round in 2021. This is in April. He invested $200,000. We've never met. We've never talked on the phone. He looked at a deck, asked me 2 questions via email, and wired the money. That feels like, man, I should have shorted everything in the world at that particular moment, knowing that there's no way this should happen. Because like I said, beverage is a really, really hard thing to get right. It's certainly the most competitive part of the grocery store, and it's very hard to build any sort of grocery store-based business. So I don't think that's possible today, and I know how lucky I was that we happened to be raising money during that particular time.
Yeah, it's wild. What's your take on the whole COVID? I think it was such a wild shift, just outside of the, talking about the disease and all that kind of stuff, to put that on the back burner for a second. But, from a pure economic standpoint, what's your take on that? Do you think there's still more downside ahead? Do you think we have like some bill to, I've written articles like we have some bills to pay from the COVID era. Do you think any of that is looming still? Or are you kind of like preparing for that as a company, or what's your take?
Good question. I'll say just first, this is obviously a controversial thing to say, but like we totally benefited from COVID. There's no doubt about it. And we benefited because there were very few options where you could find new and interesting food or, beverage oriented experiences. And the options just became the grocery store for about a year. And we were just getting on the grocery store shelves. So it was an amazing way to get a lot of feedback really quickly. And you could reach customers really easily. Everyone was at home. Give them a call. They're sitting by their laptop. No one's out and about. No one's traveling. We're all at home going to the same few grocery stores. So we certainly benefited from it. I think where I have seen the biggest kind of post-COVID shift, to your question, has been the number of both companies or both brands and retailers that felt like, and you'll probably remember reading these articles where it felt like, oh, we grew 10x in our adoption of online technology or e-commerce or whatever the metric was in a matter of 6 months. What should have taken us 10 years took us 1 year. And of course, we're seeing a lot of that shift back. Instacart just went public. They have really stellar data, but they had far more stellar data 2 years prior. Of course, we all enjoy, or I'll say most Americans enjoy the grocery shop experience. That's clear. We enjoy going and interacting and trying samples and seeing new brands, et cetera. So there's certainly a place for those delivery services, but I think there was a huge overhiring and a huge increase in inventory for a lot of these brands and services that are now coming down, which is sad because for some of them, they built really amazing businesses, but just weren't ready for the post-COVID shift.
Yeah, that's one of the things we're seeing is inventories from just a pure macro standpoint. Inventories have just like kicked way up, way past where they're supposed to be. And I think, companies said, all right, this is, COVID is going to be around for a while. It'll go away eventually, but it's going to change fundamentally how people shop. And I like how you said, people do still like going back in person. So it does change.
Right.
Behavior has kind of not completely snapped back to what it used to be, but there definitely wasn't that. I don't know if you remember that whole like new normal thing. Like if this is the new normal, it feels kind of like the old normal to me. It's not a whole lot different. We're going back to stores, we're going to restaurants. I went downtown Chicago the other day to have dinner with a buddy. Packed. I mean, it's like the most busy I've ever seen it. I used to live right down there, and it would be busy, but it was never like that. I mean, you literally couldn't find a parking spot. So yeah, I think there's definitely this roar back to regular life, if that's what you want to call it. How did you guys navigate the inventory thing? Did you get stuck with any of those same issues, or?
Thankfully not. Although I know plenty of brands that did, because their product was kind of made for at-home consumption, and they had to retool things so it looked better for retail, or their product was made for e-commerce and they had to retool things for grocery store shelves. I'd say for us, we took a couple of, I'd say, very bold bets, particularly on empty cans. There was a time where This is a very old statistic. There was a time where 40% of all the dollars I raised were sitting in a warehouse in the form of empty cans, which is like a terrifying, almost irresponsible fact. But it was during that pandemic. It was called the candemic, where there were very few cans. And if you could get a hold of them, you just needed to stock up. So we got a whole bunch of cans from Poland and we just stocked up, and they were sitting in a warehouse in Fullerton, California. But no, thankfully we did not get left with any excess inventory. So all was well, but it was certainly close.
Going back to financing for a second, Paul, are you seeing any issues? Because there's like this weird it's almost like two things are true at the same time, where there's tons of cash sitting on the sidelines. From our perspective, like consumers are sitting on tons of cash, very nervous. I just saw a Wall Street Journal survey that CEOs are like some of the most bearish they've ever been. Investors are bearish. So because of that, they've raised a ton of cash. People are sitting on the sidelines. Yeah. There was already cash before 2019. Then you increase money supply 50%. So there's 50% more dollars on the sidelines. So you got all that should be good for venture. It should be good for private equity and family office and all that. What's happened from your standpoint with financing? Are people willing to invest, or has the interest rate thing kind of changed the conversation? Like, oh, I can get 6% risk free. Why would I go, hopefully maybe in 20 years, go get 10%, you know?
Right. Yeah. I think to your latter point, the two things have happened at once. Again, I'll just speak to CPG because the goalposts are going back with a lot of the strategics, and the strategics led, Aura-Bora is one of the best examples of it. The strategics led this becoming a very profitable way for VCs and other private investors to make money. If the strategics move back the goalposts, hey, we're not going to buy at 50 million in sales, we need to see 100. We're not going to buy at 20, we need to see 80. It's now a longer bet with probably the same or slightly more amount of money needed. And if it goes from being a 5-year bet to a 7-year bet to a 10-year bet to a 20-year bet, you just referenced Spindrift. I think they've been doing this 15 years. All of a sudden, the exactly yearly return on this investment looks a little closer to your guaranteed 6% versus a speculative 12. So I think those two things combined have changed this quite a bit. No doubt, yes, the increase in cash. I can see your logic of, hey, shouldn't that be better for venture? But they earn fees on those dollars. I think probably the biggest macro trend I've seen in venture capitalists that are holding a lot of money, that have a lot of dry powder on the sidelines, is they want to make fewer bets, and they want the fewer bets to be much larger checks, which probably, to our point, is, hey, if it's going to be a longer bet, we want to make sure we hold a larger percentage of the business. So rather than writing 10 $5 million checks, we'd rather write 5 $10 million checks.
Interesting. Yeah, interesting. That's really good insight. Maybe to wrap up, walk people through kind of like the whole starting a new company, from going from like product market fit, then your go to market phase, and then now you guys are maturing and you're growing. Walk us through the kind of like the 3 steps there, and then the last step in particular I think would be interesting is, how do you grow? Like, how do you go from 20 million or whatever to 40 or 50? Like, how do you actually do that in reality?
Sure. I'll say for us, I've had the same job title for, I guess, 4.5 years now, but it's felt like a very different job. Kind of every 90 days, it feels different, which is great and fun and keeps me interested and excited. For us, I felt like the big unlock, you named 3 phases, which I agree with. The big unlock from going from like idea to go to market was frankly right there in that phrase, like go to market, i.e. once you feel like you have the right idea and you have the resources, like just get after it. I think this is probably where almost entrepreneurs end up staying on the sideline, is they have an amazing idea, a shiny pitch deck, a delicious product, a wild app, whatever it is. But there is a leap of faith required where, yeah, an investor might not get their money back, or you won't get your reputation back. You don't get your time or cash, whatever it is, back. And that's the first leap. For me, that was driving around in Subaru to my right, driving around the Bay Area, delivering products, doing samples, demos, et cetera. And then this next phase, you said kind of scaling. Absolutely. I think scaling everything, scaling production runs, scaling production locations, scaling employees, scaling teams, systems, infrastructure, et cetera. Certainly, I'd say where I got the least sleep was, how do we go from, every PO we received at one point, I was like loading onto a pallet. Eventually, I can't do that. Like, I need to sleep some number of hours and I can't load every pallet. So we need to get someone else who's loading into the pallet, or get someone else who's processing the POs, et cetera, or get a forklift. That was scaling up. And I think in particular, a lot of entrepreneurs who have already made that first leap me included, have a problem with the second one because it kind of takes a non-entrepreneur level of skill. Organization, managing people, those are kind of traditional business strengths, not really traditional startup strengths. I think most entrepreneurs tend towards product development, marketing, customer service, and don't tend towards finance, operations, logistics. And then I'd say for the third one, we can talk about this growth of, okay, great. Now you have the infrastructure, you have this idea, it's selling well, et cetera. How do we just get the same number of POs to come in, but with another zero at the end of it, or two more zeros at the end of it? For that one, I'll go back to my answer of the retailers of, there's a great, I don't know who said this. It seems like a Warren Buffett quote, but your customer's customer is actually your customer. I.e., in our case, we kind of have four customers. We sell to distributors who sell to retailers, who sell to consumers, who in some instances give away or sell to their friends. And I only get paid by one of those people. I only get paid by the distributor. But you kind of have to befriend all of them and know how each of them work in this system to grow your business. So for us, how do we go from 10 million in sales to 20 to 50? A big piece of it is correctly going from channel to channel. So you need to have a really good natural channel story before you jump to conventional, i.e. you need to sell well in Whole Foods before you can sell well in Kroger. And you need to sell well in Kroger before you can sell well in Costco. I'd say similarly, you need to have products that work for consumers that shop at Whole Foods and Sprouts, and you need to have products that sell well for consumers that shop at Costco or Albertsons or Kroger or Target. In some companies' instances, those are the exact same product. Good for them. I'd say for us, we have slightly different products that sell slightly in different ways at each market or each channel. I'd say uniquely for beverage, while you're doing that change and expansion, and it gets very big, right now, 50% of our retail dollars come from natural and 50% of our retail dollars come from conventional. The truth is, natural for a mature company, if we looked at Aura-Bora right now, I'm sure 3 to 5% of their sales come from natural and 95 come from conventional. So we have a lot of wood to chop on the conventional side. That is where most of our growth will come from. In addition, we have a lot more products we can sell in those same channels, and we can get more margin by changing our route to market. So we use a lot of very expensive distributors right now. It's pretty normal for a beverage company to eventually get on board with a Coke or a Pepsi or a Keurig Dr. Pepper, just so they can leverage their trucks and get cheaper distribution to shelf. So all of those things have to happen in quick succession in the next few years for this to work, which is part of why family offices like yours avoid beverage investments, because that's a lot of things that have to happen in not a lot of time with a lot of dollars. And there aren't very many singles, doubles, or triples. They're mostly home runs or strikeouts.
Yeah, interesting. No, that's very helpful. What would you say, Paul, in closing, to somebody who's kind of thinking about entrepreneurship, whether it's a somebody getting out of college or somebody who's looking for a search fund to buy a company, or maybe even somebody who's been at their job for 15, 20 years and is hating their life, wishing they could get out of the 9 to 5. What do you tell them? How do they make that first leap?
Gosh, I guess I'd say there are so many good reasons to be an entrepreneur, but there are a few bad ones. Like my joke always with Aura-Bora was, hey, if the idea here was to make a lot of money, like I should have gone and just bought 5 or 6 laundromats. Like there was a way cheaper, tried and true way to make a lot of money here. And to your point about entrepreneurship through acquisition, a lot of folks are going and buying 5 or 6 laundromats, and that's great. I think the negative reason would be because it's, quote unquote, easy money or a great way to make whatever life-changing wealth for you and your family. That's generally not the case. I've just felt like this was the only way I could really, really enjoy work, was doing it for myself and making something new. Maybe that's a personal problem, but that would be my advice to an entrepreneur, is like figure out the reason why you want to do it, and then make sure whatever it is, the particular industry or business you're buying or starting fits with that reason. Because I think often there's a disconnect between those two, and it makes for a very unhappy entrepreneur and often unhappy investors too.
Yeah, thanks a lot, Paul. Really appreciate it. Ladies and gentlemen, again, this was Paul Voge, CEO, founder of Aura-Bora beverage company. Check them out. They're all over the place. Get a case, try it out. It's really good stuff. I've had it. We'll be ordering another case, Paul. So excellent work there. Thank you for being on, everybody. Again, We try to bring you the clarity, the confidence. How do we do it? We give you the entrepreneurs on the front lines of the U.S. economy who are telling you what's going on. So stay on your plan, get the stories, hear what's going on the front lines from people like Paul, and stick to your plan. Thanks for being on. We'll see you next week for episode 133.